Well, welcome back to You Heard It From a CFP. My name is Matthew Coyle. Today is 2022. It is the new year. Hope springs eternal. Thanks for coming back and watching. It's been a couple weeks since I've been back here. I took some time off, did a little bit of family time, took some travel time. I am recharged. I'm ready to go. I've got charts right here, and I'll walk you through them on why I think the next year, or maybe even the next few years, could be very good for equity investors in the new year. And the first chart I'm going to show you is a chart of the core inflation rate versus the rate on a government bond. All right, and this is very important. So we're going to start off, and then we're going to go from here. So the red line on this chart is the rate of the core inflation rate. The blue dashed line is the rate on a government bond, a 10-year bond, going all the way back to the year 1880. Okay, we have a lot of data on this, so we might as well use it. It comes from Bloomberg and the Federal Reserve. So what this particular chart is showing you is the rate of return on a 10-year bond versus inflation. And contrary to what most people think, well, you wouldn't guess this up front, but about a quarter of the time, 26% to be exact, from 1880 forward, the rate on a government bond is actually below that of inflation, meaning it has a negative real yield in economic terms. So we are about to go negative again, and the reason this is significant is because its relationship to equities. Typically when this happens, it's a good time to be an equity investor. So it is not fairly that uncommon, about a quarter of the time, like I said, that a government bond yields you less than the current inflation rate, or like I said, is a negative real yield. And now, why is this important besides the fact that it's historically significant? We're about to go negative again, because even if the Fed tightens 2 or 3 times next year, which they probably will, we think, the rate on a government bond is unlikely to rise above that of the current inflation rate, which is elevated because of the COVID situation, everything going on there. So why is this significant? It's significant because of its relationship to the stock market, and historically, it has been a good time to be an equity investor when this happens. Now, because we're about to go negative on rates again, most likely, no guarantees, but it looks like we will, it definitely would make stocks more attractive, particularly in the next year or two. Now, anything can happen if we get some major political shock or a geopolitical event or a war or some major change to the COVID situation we've already got. Then all bets are off. Things could change. However, if we go negative on rates and looking at how history has performed in the past, it should be a good equity market for the next year or two, you would think, based on previous market experience. All bets are off if things change. However, the past results, even though they're not a guarantee of the future, seem to indicate a pretty good environment for equities going future, just because most people are relative buyers of investments, not absolute. Everybody has to put their money to work because cash is a guaranteed loss. And if you're going to get one return over another, you'd much rather take a return that's positive or likely to be positive versus a return that's guaranteed to be, at least in the short run, negative, which in this case would be a government bond if it's below the rate of inflation. So that is a chart of historical inflation versus the 10-year bond versus stock prices. And there's almost never been a time when we've been negative on the 10-year bond in real terms and the stock market hasn't gone parabolic. This particular chart comes from Bloomberg. It's a chart from the late 1980s until now, as far as the percentage of companies beating the S&P 500 within the S&P 500 index, and the percentage of companies inside the index that are beating their earnings expectations each and every quarter has been rising since the 1980s, mostly due to technology, more efficiencies. They're just becoming much better at what they do. A great example of this would be Nike. Nike actually just announced for the first time in history their direct-to-consumer sales, meaning outside of the retail environment. Direct-to-consumer sales, you order on the website, it goes to your door. That just crossed 50% of Nike's sales globally for the first time ever. That's a big deal, and it's going on across the entire S&P 500. They're deploying their technology, they're deploying more efficiencies, and they're simply becoming more profitable. All right, chart number 4. Speculation in the market is coming down, not up. This particular chart comes to us from Charles Schwab, and it's actually the Goldman Sachs non-profitable tech index. So basically it's taking us companies in the marketplace that are not profitable, typically thought of as lower quality, more speculative stocks that some people claim were driving the market in 2020 and early 2021. I don't agree with that, but it was said that that's the case. In this particular chart, what this is showing you is Goldman Sachs's tracking of non-profitable, low-quality tech stocks in the marketplace and the speculation on those companies. What's driving this latest market surge is not necessarily speculation, it's earnings growth, as I showed you in the previous chart, but also speculation in the market has come down and not gone up. This is contrary to what many people are saying in the market today, and this is very interesting because it means that there's more investors coming into the market and not traders. And if you like long-term healthy markets with lots of buyers who are interested in staying in and owning stocks for the long term, this is exactly what you want to see. You want to see an environment of low rates, long-term investors, a lack of, limited speculation, and high-quality earnings, and you're seeing it right now. So this does set up well for the market for the foreseeable year or two again. Full disclosure, no guarantees, but it's nice to see that speculation in the market has come back down versus on these low-quality, non-profitable companies. It also means that the market could be broadening out as far as value versus growth. So for those of you who can't take as much risk, but you still want to own equities, this is good for you. Okay, we're on to chart number 5, inflation. You know, inflation was the story of the day. It still kind of is the story of the day, but it was really the story of the day about 6 months ago. And, you know, Bloomberg actively tracks, and that's where this chart comes from, Bloomberg actively tracks the 5-year forward inflation expectation rate, and that number has come down over the last 6 months. It was expected to be higher 6 months ago than it is now. It's nice to see this. This will save everybody a little bit of money, especially younger people who want to buy homes, or younger people who want to start families, younger people who invest in the economy, all that stuff, which moves me on to chart number 6, which is demographics. Let's talk about demographics for a second. We have a very, very favorable demographic situation in the US, one of the best in the world, despite what you may hear. Of course, as you may have heard, the millennial generation is now the most populous generation in the United States, which is great because that's typically peak spending, a 35 to 50-year-old person. Myself, I'm a Gen X. We are no longer, and have never been, the largest demographic in the country, even though it probably feels like I'm at peak spending some days. So the millennial generation is now officially the biggest generation in the country. They're going to be buying homes, they're going to be buying cars, they're going to be buying home furnishings and having kids and do all those things that matter, that drive spending in the economy, and they're doing it under an inflation expectation that's now going down. So very favorable. I like that. That's a very nice thing to see. I'm going to stick with demographics for a second. Here's another one. This one comes from the Bureau of Economic Analysis and Bloomberg. Interesting to see that we have now, from 2008 on, we've now got a much larger number of prime skilled U.S. adults, age 30 to 48, which is surging through the economy right now. That number is moving dramatically higher. So very nice to see that. I'll move on to the next chart, which of course is housing and equity markets. So this will be the last chart I look at. But if you follow demographics, and I think demographics are very, very important to the economy, the youth and innovation within a society is very important. And if you look at what happened from the 2008 financial crisis until now, primary debt levels, assets relative to the economy, Gen X, Millennials, Gen Zs, we now, if you overlay the number of adults in prime leverage age, which is age 30 to 48, against the 10-year total return of the S&P 500, it's amazing how well this lines up. And it speaks very favorably to the demographic situation in the country right now. And this implies more gains in the stock market. It typically has. If you believe the data, if you look at history and believe it's going to guide you to another answer, this could very well result in very good stock returns for the next 5 to 10 years. I mean, who knows? Again, full disclosure, no guarantees. But the generation coming up behind me, which is the millennials, I'm a Gen X. The millennial generation is in a prime seat here to have low interest rates for a prolonged period of time. Hi, Leo. How are you? Is poised to have some pretty low interest rates when they buy homes and start families and do all the things that they're doing. And it sets very nicely up for the future. So I think I'm going to leave it there. Leo looks like he's hungry. So we're going to jump off. And thanks again for watching. I'll see you next week. And take care. Thanks.